China's market is soaring. What happens? The Chinese Central Bank, People Bank of China, PBOC, cut rates following the Federal Reserve's significant 50 BP in September and implied further rate cuts later this year. However, the most important message is, brokers are allowed to use funds from PBOC to buy stocks, which makes people recall how Bank of Japan have bought ETFs to boost Nikkei since 2012. Notably, PBOC has allowed brokerage firms to pledge the stocks they hold as collateral to borrow highly liquid assets such as government bonds. These bonds can then be sold, and the proceeds used to buy more stocks, creating a potential for an endless loop of borrowing and reinvesting. Foreign investors may not be aware that the PBOC has been troubled by the persistent rise in Chinese government bonds prices for some time. Domestic investors have been heavily long on China's long-term government bonds, believing that, similar to Japan, it is only a matter of time before yields reach zero. Currently, the yield on China's 10-year Treasury yield stands at 2%. Given the perception that yields have significant room to fall further, going long on government bonds has become one of the most popular trades. The PBOC, however, sees long-term government bond yields as a reflection of long-term economic growth rates and does not want yields to decline too rapidly. Therefore, it has been encouraging brokerage firms to buy stocks and sell bonds to counteract expectations of economic recession. My greatest concern, however, lies in the practice of borrowing government bonds to purchase stocks in a looped process. This increases the leverage of financial institutions, and due to the negative correlation between stocks and bonds, this trade offers no hedge or risk protection. As a native Chinese, I maintain a cautious stance on this development and will continue to monitor the situation closely. In addition, PBOC will provide low-interest loans to companies to buy back shares and hint at the imminent establishment of a stabilization fund. The loan interest rate is set at 2.25%. If a company's dividend yield exceeds 2.25%, stock buybacks could potentially enable risk-free arbitrage. This mechanism may help boost high-dividend companies, such as China's large state-owned banks. I believe this development is positive. However, these high-dividend stocks are already trading near historical highs. Whether the optimistic outlook has been fully priced in remains uncertain. This article reflects my personal thoughts and should not be construed as investment advice for others.